the course outline. The course outline, ladies and gentlemen, how does it look like? Course outline. So the course outline, ladies and gentlemen, the most important thing if you want to pass this paper, right away, get to love it right away. In joining this section, you have to know what is expected of all of us. What is expected of us? So it's paper number 14. It is advanced financial reporting and analysis. Advanced financial reporting and analysis. So unit description. This paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to account for more complex transactions, prepare advanced financial statements and reports in the private and the public sectors, and demonstrate awareness of trends in accounting practices. And gentlemen, please listen and listen to me very well. It means that at the end of the day, we must be able to know how to prepare financial reports for private companies. Private companies basically are these companies that are profit-making. Companies that are private, profit-making, ladies and gentlemen, we shall always use what we call IFRS, or IAS to come up with their financial reports. IFRS is International Financial Reporting Standards. International Financial Reporting Standards, and then we have International Accounting Standards. Now remember, when they were coming up with these financial reporting frameworks, they began with the IASs. IASs in this case here were, the only standards when we began. But nowadays, because of, monitoring and evaluation, whenever they have, in this case here, an IAS that has been overtaken by events, what they do is just to replace it with what we are calling what here? IFRS, International Financial Reporting Standard. At the end of the day, ultimately, all IASs here will be removed, and we shall be dealing with what we call IFRS, although we still have what here? A couple of IASs still. Like, for example, IAS 1 now has been replaced by what we call IFRS 18. All right, so slowly but surely, IAS in this case here is being replaced. IAS is being replaced. All right, so then this is number one. According to these financial reporting standards, or rather according to this advanced financial reporting paper, we must be good with IFRS, stroke IASs. And then number two, they're also talking about public sector. They're talking about public sector. Public sector, these are not for profit organizations. So organizations like, for example, the UN, organizations, for example, like government ministries, all right? Them, in this case here, we shall be preparing their financial reports using what we call the famous IPSAS. IPSAS is International Public Sector Accounting Standards. International Public Sector Accounting what here? Standards. So whenever you hear of International Public Sector Accounting Standards, IPSAS, you know that these are those standards that are normally used to produce financial statements for organizations that are not for profit, non-profit making organizations like the United Nations, churches, etc. You know, like if you look at these non-profit making organizations, of course, you can't tell me that they are pursuing losses. No, they'll still pursue surpluses, but they have a higher calling. They have a higher objective. Like you see, a very good church cannot have like our objective is to maximize profit. No. Ladies and gentlemen, a good church, we know that their objective is spiritual nourishment and ensure that they take as many people as possible to heaven, ultimately. All right? That is the first objective. And then, of course, these are objectives here now, like surplus. Of course, they have to get surpluses here and there, but that is normally not the key thing. So in this case, a student who will be able to pass this paper should be able to know IPSAS inside out. They should be able to know IFRSs inside out. So, for example, just in the sitting, they wanted us to differentiate between IPSAS 9 and the IPSAS 23. IPSAS 9 and IPSAS 23. Fortunately, some of these IPSAS, you guys have done them from the lower levels. Financial reporting of intermediate level. Financial reporting of intermediate level. Fortunately. So they wanted us to differentiate between IPSAS 9 and IPSAS 23. Ladies and gentlemen, IPSAS 9 talks about what here? It talks about revenue from exchange transactions. Revenue from exchange transactions. IPSAS 23 talks about, in this case here, revenue from non-exchange. From non-exchange. From non-exchange transactions. Now listen to me very well. If you look at the United Nations, of course, member states normally stand with it. The member states for these kind of United Nations organizations, you'll get member states doing donations. So when they donate like this to these organizations, these member states, they don't get anything in return. They don't get anything in return. So basically, this is revenue that we're getting as UN from non-exchange. We haven't really done anything. We have not given these member states anything in return. There is nothing they have bought from us. They have only given us a donation for us to be able to operate smoothly as an organization. So that is what we call revenue from non-exchange, because there is nothing you have exchanged. Ladies and gentlemen, if you look at, for example, churches, of course, churches like Catholic Church is doing a wonderful job. These guys have the very best primary schools, the very best secondary schools. They're also in hospitals. I mean, they're doing a great job. So you can see they're offering a service, and at the end of the day, they're getting what here? Revenue. So then, yes, they are not for profit, but you see there are some activities they're doing here. These activities, they are giving away some service, and in return, they are getting some revenue. That is what we call revenue from exchange transactions. Because at least there's something you have given out to be able to receive this money. Revenue from exchange transactions. The same churches, when you go, ladies and gentlemen, and they give a donation, you give like a tithe to your pastor. When you give a tithe, the tithes you give to these churches, will they be accounted for under exchange or non-exchange? Please comment there. Please comment there. The tithes we give, will they be accounted for under exchange or non-exchange? Please comment there. Comment there. The tithes we give. The tithes we give. The tithes we give. Will they be accounted for under exchange or non-exchange? Ladies and gentlemen, automatically when you give a tithe to your pastor, there is nothing you are buying from him like directly. Of course, I know there is the concept of blessings coming from heaven. That much I know. But you see, when you give this tithe to this gentleman or this lady, honestly speaking, there is nothing in return you are getting directly. So then that will fall under what we call revenue from non-exchange transactions. So if you go to the United Nations, for example, talk of a statement of surpluses, all right, or statement of performance. So you'll see them articulating on two types of revenues. They always mention on their face, revenue from non-exchange, revenue from exchange. Now, these people who came up with these IPSAS, they are very, very bright. They know that they knew actually a long time ago that ultimately most of these not-for-profit organizations shall be required to pay taxes. They shall be required to pay taxes on their exchange revenue, exchange. Exchange revenue, ladies and gentlemen, in this case here means that, fine, you are not for profit, but you have got some sections within the United Nations, within the church that are doing business. Let those sections in this case here pay taxes. That's why they wanted us to come up with what here, that kind of a segregation. Segregate, separate. Tell us in this case, your total revenue is 10 million. Out of this 10 million, how much of it is from exchange and how much is it from non-exchange? Perhaps 6 is exchange, non-exchange is 4. So from this exchange of 6, you'll be told in this case here to pay what? You have to pay taxes. You'll be told to pay taxes. You'll be told to pay taxes. Now, why am I speaking about this? Ladies and gentlemen, for the years that I've been teaching, and of course, marked exams, I'm aware that AFR, and I can assure you, lots of assurance from me to you, AFR theories are very, very important. They account for more than 30%, and most of us always think that it is about what year? It is about just number crunching, looking for goodwill, looking for this. No, we must also, in this case here, be good with theories. And if you ask me, whenever you go to any question in an exam, If there is, for example, part B, C, they have got some theoretical questions, you can even start with them. Knock away those marks, all those marks. If there is anything I teach here at RCM College, like the early morning classes mine, if there is anything that I normally emphasize, and this is why very many students in this case normally come our way, all right? Even the one who teaches in the evening here, perfect gentleman, all right? Ladies and gentlemen, people in this case here follow us because of some of these small, all right? We also look at this theoretical area, all right? On top of the quantitative, we take our students in this case through this theoretical framework so that we can help them maximize on number of marks that they get to do what year they get to earn, number of marks they get to earn. All right. All right. Ladies and gentlemen, please listen and listen to me very well. That is just a brief discussion on the IPSAS. We shall be looking at the other IPSAS as we get along. For example, all public listed companies, not public listed, but not for profit companies, they must come up with budgets. There's a whole IPSAS talking about budgets like that. So let's get back here. Now, ladies and gentlemen, learning outcomes. A candidate who passes this paper should be able to prepare financial statements for subsidiaries. So we're going to meet group consolidation here. Should be able to analyze financial statements for public and private sector entities. So earnings per share, etc. Account for complex accounting transactions. Apply ethical standards in accountancy, work and practice. Very, very important. Now, ladies and gentlemen, from there we come to content one. So content one, they simply want us to look at how do we recognize, how do we measure assets and liabilities? Accounting for assets and liabilities. Measurement, subsequent measurement after we have measured originally, subsequently with depreciation, we have a recognition, the recognition. Those are the kind of things they want us to look at under chapter 1, under what they are calling accounting for assets and liabilities. 1.1 is about the previous knowledge you got from the other papers. 1.2, which is IFRS 16, talks about leases. Under leases, ladies and gentlemen, we are required to know how to account for lessees. So we have lessees accounting. So in this case here, the people who are leasing our assets, we call them the lessees, like the tenants, the lessees. So in this case here, we have lessee accounting. Then we have, ladies and gentlemen, the lessor accounting, very, very important. Lessor, L-E-S-S-O-R. So if you're the landlord, how do you do your accounts as per IFRS 16 leases? And then you can see here, they have told us, it doesn't end there. They have told us that we must be able to know how to do what we call sale and leaseback. So under sale and leaseback, remember like what happened with Uchumi Supermarket. Uchumi Supermarket at Agakano. These guys, they became broke at some time. Once they became broke, they were forced to sell their headquarters. They were forced to sell this branch at Agakano Walk, Nairobi. They sold, but they told those owners, new owners, that you know what? We are not leaving this business. Please lease out this space to us. So they sold and then leased back. Sale and lease back. Very, very popular in your exams. Sale and lease back. Very, very popular in your exams. Sale and lease back. These ones here. Sale and lease back, including dealers in leased assets. Now from there, we have deferred tax with group aspect. Ladies and gentlemen, remember deferred tax, we're looking at IAS 12. So under IAS 12, if you can remember, accounting for taxes, your examiner wants you to know how to compute temporary differences. Temporary differences, of course, will lead to what we call deferred tax. And then we also have what we call permanent differences. Permanent differences, if you remember from your AFRA, I'll be able to define this again. And the permanent differences, ladies and gentlemen, if we have books of KRA here, and then we have in this case here the P&L, for example, here done by you, accountants here. So you see there are expenses that you will incur yourselves, which can never be reversed in the future, which can never be allowed by the taxman, So for example, if you have an expense like say fines, you've gone in this case here to court and that you've been fined over some mistake that you did as a company, the fine will appear in the P&L, but you see it can't appear here. So it means that the difference between what the accountant has and what the taxman has is permanent. It shall never change. There is not a single day in future that the taxman will be able to come and say, hey, let's allow those fines. For example, donations to non-registered charitable organizations. You just go and make a donation like that. The taxman will never allow that in future. So automatically that difference is what we call the permanent difference. And you're going to see, ladies and gentlemen, the impact, of course, on our deferred tax, which will not be there. But for now, I'm just giving you an overview. And the examiner is talking about us now introducing group aspects here. For example, what is a deferred tax on goodwill? Things like that. Great subject we have here. It's called advanced financial reporting. It's called advanced financial reporting. Now, from there, ladies and gentlemen, we have the next item here. The next item here is called employee what here? Employee benefits. Remember, employee benefits, ladies and gentlemen, is IAS 19. If you're taking your notes, employee benefits is IAS 19. Employee benefits is IAS 19. Now, whenever you're working with employees, remember at the end of the day, you have to give these guys here benefits, some benefits here. If you don't want to lose them, if you don't want, in this case here, the labor turnover to be very high, there is what you always have to do. What you always have to do to ensure that you keep them. So you must give them what we call what here? Benefits there. You must give them benefits. So these benefits, as an accountant, you need to know the types of benefits that we're talking about. So of course, we have long-term and short-term benefits. Long-term benefits, for example, are those benefits that give these employees upon retirement. So these upon retirement, we are looking at like pension. So we have got two types of schemes. You remember this long-term. We have what we call the defined. We have what we call the defined. Of course, we shall be reading. I'm just giving you. We have what we call the defined contribution scheme. The defined contribution scheme. And then number two, we have what we call the defined benefit scheme. The defined benefits scheme. In many cases, the examiner has always told us to differentiate between the two. So assuming we have an employee at RCM. So this employee at RCM, ladies and gentlemen, this employee at RCM, what do we have here? Now, there are those great companies which would want to see their employees post-retirement living an above average life. You know, there are people who know that when these retired employees out there are living very, very well, it's a form of marketing to the organization. So then from the day you enter this organization, like if it's RCM, we are able to project and say, by the time you retire, we are guaranteeing you 30 million. So we define the benefit you're going to receive. We define the benefit you're going to receive. So it means that if there will be any actuarial risks, we talk about actuarial risks, then we as RCM will bear any of those kind of risks. Because if, for example, we have promised to give you 30 million, and then we are making our contributions here now to some scheme, and then we realize, hey, the way things are going, this scheme may make a loss. If it makes a loss, my person there will not be able to get the 30 million. So we'll be called upon to increase the contributions to enable this guy to get his start. So we take the risks associated with us not being able to deliver on our promise. So that is called what here? Defined benefit scheme. Defined benefits scheme. And then now, ladies and gentlemen, from there, we have what we call the defined contribution scheme. So under defined contribution schemes, this is what 99.9999% of companies in Kenya have. So what they will do, they will come and say, hey, we have employed a lady called Rose. So Rose, in this case here, we are going to deduct her 6%. And then we do what here? 6% the company. So company does 6%, employee does 6%. So in short, we are talking of 12%. of our salary, or not of our salary, 12% of our salary being taken through this pension scheme. 6% from her and 6% from the employer. So we give this, for example, to a third party like Britam, like CIC. We have a scheme with them. We have an arrangement with them. Now, once we have an arrangement with these fellas, what will happen, as we are only obligated to make the contributions. If these Britam schemes and whatever make losses, and the employees upon retirement don't even get anything, or they get something but not that substantial, we as RCM, we as an employer will not bother. We have watched ours. In this case, the responsibility is on the contributions that we are making. That's IS 19, a very good scheme. It is on the contributions that we are making. IS 19, beautiful standard. Beautiful standard. So in this case here, both of them have got different accounting treatment, and I'll be able to teach you these treatments as we get what year, as we get along, as we get along, as we get along, as we get along. All right. Now the gentleman from there. I mean, we would learn so many things here. AFR is a beautiful paper. If you get somebody in this case, you're telling that AFR is a hard paper, they're cheating you. Very easy. So from there, we go to what we call share-based payments. Share-based payments, these are captured using IFRS 2. I mean, it's IFRS 2 that shows us how we should be able to account for share-based payments. So when you talk of share-based payments, first of all, you'll be made to understand what share-based payments are. What share-based payments are. You'll be forced to understand what share-based payments are. And the share-based payments, we have these employees who are so talented. They could be our senior employees, senior executive employees. So these senior executive employees would want to keep them for the longest term in the company. So then what we shall do is to promise them shares of the company. We tell them that should you serve us, say for 10 years, we're going to give you like 6% of the shares of the company. So of course, we are paying that 6% on some performance. There's a performance obligation. So it's a payment, but in form of shares. So that will be called a share-based payment. And if it's a share-based payment, then how do we get really to account? You're going to see very good terms here. Like for example, we have equity settled share-based payments, where you give these guys at the end of the day company shares, which then would mean that the company's share capital will be affected. You must credit the company's share capital during this time of, in this case, you're giving them the shares. And then we have what we call cash settled. So fine, we promised you shares, and we promised you, to make a payment to you. If, for example, the share price is at some value, for example, the share price has risen, say to 10 or to 20, and then we say we're going to give you money now on the basis of the performance of the shares. So it is still share-based, but we shall not give you shares. We shall give you cash. It's called cash settled. It's called cash settled. Cash settled, in this case here, scheme. Beautiful terms you shall be able to hear. Now, ladies and gentlemen, after that, what else do we have? We have what we call financial assets, financial liabilities, impairment, hedging, embedded derivatives, and disclosures. These basically are under different, in this case here, different what standards. But we have what we call IFRS 9. So under IFRS 9, you will be able to see us talking about what here, for example, these derivatives, ladies and gentlemen, you'll be hearing us using the concept of SPPI test. For example, SPPI test. You'll be hearing things like this SPPI test. So whenever we talk about SPPI test, it means that this is, for example, a bond that we are keeping in our company for solely payments of what year? Principal and interest. So we are keeping this particular bond with ourselves here until maturity. So in the process, we will be paid our principal and interests. So it's a long-term bond. It's not held for sale. We don't want to sell it solely for payment of principal and interest. Ladies and gentlemen, you're going to see great things over here. You're going to see, for example, if it's a long term, I mean, very good. Their bonds, whenever they change value, their bonds, whenever we do valuation, they have changed value. Whenever they change value, that increase will be taken to the P&L. And fair value, we talk of fair value through P&L, fair value through profit and loss. That change, increase or decrease, we shall pass that through the P&L. And there are some bonds, some assets. Whenever they increase, we shall not be taking that increase or decrease in the P&L. We shall be taking that increase or decrease to the OCI, what we call other comprehensive incomes. And most of them all, basically the concept will be coming out of what year? And we shall be able to see, ladies and gentlemen, what are embedded derivatives. I normally give my students a very good example. You know, to embed means what year? You are in bed. So it means it's a compound financial instrument. Compound financial instrument. There is something in this case here for coverage of what year? For coverage of risks. For coverage of risks. So you shall be able to look at this, ladies and gentlemen, and I can assure you this will be a great deal. This will be a great deal. Now, from there, we go to fair value measurement is a standard that is quite close to my heart. It's IFRS 13. IFRS 13 is what we call fair value measurement. What do you think in this case here does this standard talk about? Fair value measurement, IFRS 13. What do you think does it talk about? Very good standard. Very good standard. Very good standard. Very good standard, IFRS 13, a very nice standard, fair value measurement. Now, ladies and gentlemen, you know, fair valuation is something that exists like across our IFRSs. But the ISB board sat down and they thought, it's important we just have one standard that basically is ostensibly for measuring assets, So we have one called what here? Fair value measurements here. Fair value measurements. IFRS 13, I like it. So when you're measuring, in this case, ladies and gentlemen, assets, there are things you look at. If, for example, I'm measuring the value of this particular asset here, and we happen to be having other pens, identical pens, then we shall be seeing how we use what we call level 1 inputs. Level 1 inputs. Level 1 inputs. Because of an identical asset existing in the market and it is being sold. That's level 1. And then, ladies and gentlemen, we shall be having in this case here, for example, we want to sell like, say, Holy Family Basilica. It's a church whose design, I doubt whether you can ever get any other church that is exactly identical to that kind of a church. So that, of course, there is nothing is near to it, nothing identical, nothing near to it. There is no similar. So that one we shall be using what we call level 3 inputs. That's far. To value that is quite tricky. But again, we have level 2. Level 2 is where, of course, it's not identical, but at least there is something that is close. All right. For example, I want to sell my 3-bedroom bungalow. To sell this 3-bedroom bungalow, then I would need to look around. I mean, I may not get exactly a house that is matching exactly like mine, but at least there is some similarity. This one here went for 20 million, looks like mine, but I've got this maybe extra thing, so I reduce the value to get mine. So fair value measurement, great standard, great standard. Fair value measurement, great standard. Great standard. Now, the gentlemen, from there, we go to the last one for today. I don't have to discuss like everything. I just wanted to give you guys highlights. here. So the very last one is what they are calling impairment of assets. Impairment of assets is another standard that is very, very similar. Very, very similar. Very, very similar. Very, very similar to what I'm so sure you must have covered this somewhere. It's called IAS 36. IAS 36. You must be able to master those standards the way I've mastered them. IAS 36, you must be able to master them. Both in terms of what here, knowing their names, and the content. This one here, impairment of assets. IAS 36, ladies and gentlemen, assets, just like human beings, we get impaired value-wise. Trust you me, right now you are able to move fast, walk fast, even at times on high heels, and then you are walking straight. You have the energy, all right? But after some time, whether you like it or not, you'll have to bend. Once you'll be very lucky if you hit 80 and then you are still standing straight, you'll have to bend. So in this case here, you become less productive. The same case with these physical assets. It reaches a time when they become less productive. They were producing like 1 million units every whatever. Now they're producing 200,000 units only. So they become less productive. Such assets, you can't say that that kind of reduced production is because of depreciation. That loss is too huge. So we talk of what we call impairment of assets. Very, very popular. Impairment of assets. So we have here what we call IAS, what here? IAS 36, impairment of assets. So whenever we talk of impairment of assets, then I'll be able to teach you how to calculate impairment loss. I'll be able to teach you how to calculate impairment loss. How do we get impairment loss? It is CAR minus RA. It's CAR minus RA. So CAR is carrying amount minus recoverable amount. Carrying amount minus recoverable amount. Carrying amount minus recoverable amount. So if, for example, you are carrying this asset at 10 in your books, and yet the recoverable amount, for example, is 7, you can see straight away, ladies and gentlemen, that there's an impairment loss of 3. And we're going to see, ladies and gentlemen, that to get RA, to get this recoverable amount, there are two things you must look at. Number one, you know, this asset you have, it is either you sell it or you use it. So you'll be looking at 2 things here. If I sell it today, what is the selling price minus, of course, the cost of selling? All right. So this asset is going for 10 million. And of course, the guys want commissions of say 10%. So I'll have to give them. So in this case here, the sales price less those commissions will be 9. How about in this case here we talk of value in use. And the value in use, we are looking at if we stay with this asset and it continues with production, what are the cash flows that will be generated even in the future? Those cash flows are the ones that we discount. We discount those cash flows for us to be able to get what we call value in use. So value in use basically is the present value of associated cash flows of this asset. So in this case, you will take 9, and maybe in this case here, the value in use is 8. So then you come and ask yourself, what is the proper decision for this asset? Do we use it? Do we stay with it? Or do we, in this case, you're selling it, fetches more money. So you sell it. So in this case, the recoverable amount will always be the higher between the two. Recoverable amount will always be the higher between the two. Recoverable amount will always be the higher between the two. So I simply wanted to take this opportunity to just go through what is required of us, ladies and gentlemen. What is required of us, ladies and gentlemen, in this particular subject, especially for topic 1, which now will be starting from my next class. I'm tackling topic number 1. Topic number 1 is very, very critical for you guys. Very critical. Knowledge of those standards, very critical. So I normally move quite fast on it. For me to be able to really do you guys great, I would recommend that as you join us, you also ensure that you have these books. Ensure that you have these books. These are RCM's revision kits containing CASNEB questions and answers. And we are selling them for just 1,000 for 1,000 shillings, and we are able to deliver. So of course, in this case, you look at 0793. This is our number. You call us, then we shall be able to deliver. And then, of course, I don't think you really have much of a choice other than joining our online classes. When you join our online classes, ladies and gentlemen, we give you 3 things. You will pay 4,800 for our online classes. And with this 4,800, we'll give you access to our Zoom live classes, like now what you're doing here. Zoom live classes, you are able, like I saw you guys making contributions, you are able to contribute. You are able to ask questions. So we give you access to our Zoom live classes. That's number 1. And then number 2, ladies and gentlemen, we shall give you access to videos covering the whole syllabus. Of course, these are previous semester videos We give you access to those videos. This is for those students who like reading ahead. Whenever they have time, in this case here, they simply go to what we call our learning management system, and then they get to watch those videos. They get, in this case, to do what here too? I mean, you know, in the LMS, we also have so many questions tackled there. You know, in the live classes, we may not be able to do so many. That's why we give you both the Zoom classes and what here, the learning management system. That's number 2. Then number 3, of course, if we have some students who have already paid here, you know that we shall be able to give you access to what here, really great notes here. That's RCM for you. So you pay 4,800 for this. Unfortunately, you can't tell me that Molima only wanted this. Now, reduce this price. No, the 4,800 is cast on stone. We can't even negotiate on it. The only thing we do is that we accept installments. The 4,800 is per subject. 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 Now, for those of you who would wish really to join us, like even today, we have already begun our classes. We began on the 6th of May. Of course, we haven't done much. We've been waiting for you guys. Please come here and make your payments to this pay bill number. So the pay bill is 62,42,839. Account number is your subject here. You are subject, so we are talking about what here? We are talking about AFR, for example. AFM, you write like that. ETC, ETC, ETC. And we have all CPA papers. We have all ATB papers, all CIFA papers. And we have early morning classes, evening classes. And now we are also introducing the day classes for those students who have time during the day. I mean, they don't have to wait like the whole day to come to a night class like now. No. Otherwise, ladies and gentlemen, from me to you is bye-bye. I sincerely hope that you've gotten value from this discussion. For the students who are following me on Facebook, YouTube, I expect a comment down there. That's how you uplift Mwalimu in this Google search engine, right? And of course, you must subscribe. Otherwise, thank you very much. Be blessed and bye-bye. And please preach the gospel that RCM is the place to be. RCM is the place to be. Thank you. Thank you, Keter Geoffrey.